Hims had an explosive earnings double beat and guidance raise. We're going to get into that, and we're going to get into my valuation analyzer tool to see what Hims is worth and what you should be buying it at now. So let's get into it. So Hims absolutely destroyed their earnings call. They came in with revenue beat of $401.6 million versus last year's number of $226.7 million, a 77% year-over-year increase. They had a net income gain of $75.6 million, which is about 18% profit margin, considered to a $7.6 million loss the year prior. They also had an adjusted EBITDA of $51.1 million compared to $12.3 million the prior quarter. 317% year-over-year gain. Operating cash flow of $85.3 million compared to $25.2 million. 238% year-over-year gain. And my favorite, free cash flow. We had a $79.4 million free cash flow for this quarter compared to a $19.3 million free cash flow the year prior. A 312% year-over-year increase. Just massive. This puts their trailing 12-month free cash flow at about $159 million, which is just epic. And when we get to our valuation analyzer tool, you'll see why it's so epic. Due to us mainly using a discounted cash flow yield or cash flow to understand what we should be paying for the company, along with other valuation tools. But the discounted cash flow is the model is one of the best that I use, and it's the most consistent. So also we had subscribers growth end of period. We have now 2 million. Hims and Hers have reached 2 million subscribers. Absolutely epic. A 44% year-over-year gain. They wanted to get to 2 million subscribers by the end of the year, and they got it in the third quarter. This company has explosive growth, and they are absolutely demolishing everything right now. Monthly online revenue per average subscriber also went up. So they're gaining subscribers. They're increasing their monthly online revenue per average subscriber. 24% year over year. I mean, look at these numbers, everybody. Look at these numbers. I'm sorry to say this too. Earnings in the stock price after hours, it was just ridiculous. It was ridiculous. They were playing games with this stock. It went up 8%, then it dropped down to 7%, then it ended after post market, it ended up being 9%. With these earnings and what we are seeing with this company, this should be up over 20% before the end of the week. Especially once we get to my valuation analyzer, you're really going to understand why this company is so undervalued and why it's a steal deal right now. And how it's a steal deal going forward into its immense growth over time, and how Hims is still a 10x opportunity, even since it went up. It's gone up a lot since its bottoms. So moving in to some other things, share of total subscribers versus utilizing personalized products, both uptrending very nicely, not losing any ground either way. 175% year over year from the prior. We also have here, skip through some of this stuff. Advanced capabilities are bringing personalization to a wider audience. 1 million subscribers utilizing a personalized solution, which is just huge. I mean, they're using AI. They're using this personalized solution, and it really gives you that obviously I don't want to say personalized field, but it really gives you that, it's not just online. They actually care. They're actually trying to heal you, help you, make you better. And that is really hard to do when you have a service like Hims and Hers, but they are so good at that personableness. That's the word I'm looking for, personable. They're so good at it that it's one of the biggest reasons that they're continuing to just kill it in the market and in this field. So let's get through some of this stuff. Also, Scaling Technology Platforms offers consistent and widespread access to care. So they're continuing to make the system simpler and continue to just expand what they're doing here, and making everything seamless and simple. And that's what you really need when you're in a field like this. Just and this is why they're disrupting. This is why they're disrupting this field. It's absolutely amazing. This company is so underrated. So let's continue down here. Let's see. I love the products. They got a lot of weight loss stuff, generic weight loss stuff. Mental health is obviously, massive, sadly, across the world. And, being able to have testimonials of Hims helping and being somebody's saving grace is obviously very, very awesome. Is just a human being, obviously. And the weight loss stuff is obviously very big. There was a lot of FUD around the weight loss stuff with Lilly and all this, Eli Lilly and everything. And it's a smaller portion of their revenue, so I already knew that it wasn't going to be that big of a deal. But the stock crashed over 14%, and I was screaming about it and how it was a great dip buying opportunity, which it was, obviously. So kudos to anybody else that was out there buying the stock. Super, super awesome. And they crushed it for us shareholders. So love to see that. They, like I said, they had a double beat and a raise on their guidance. They went from they went to a 465 to 470 million revenue for next quarter, about 90% year-over-year growth. And then they went to a fiscal year 2024 revenue of 1.46 billion to 1.465 billion, a 67 to 68% increase year over year. EBITDA also was raised to $50 to $55, 11 to 12% margin, and then a 173 to 178 adjusted EBITDA with a 12% margin. We got the financials down here, as you can see on the graphs, just continued upward trajectory. We have our online revenues continuing higher, while we have our wholesale revenues kind of 10 here and then dropping to 9 and 9 million here. And it's not the primary revenue outlet for this company. So just to see it even stagnate, just to see it continuing at 9 million, is nice. It's just the cherry. It's just it's just a cherry on top. So what we really care about is the online revenue, just continuing to climb higher. And look at this massive run up. I mean, you almost doubled this bar from $220 million this time last year to now $393 million in just one single quarter. Just outstanding. Just clicking on all cylinders. This company's they're on a warpath. The only negative I could find in honestly the whole earnings, it was a tier 1 earnings. The only negative I could find on this would be the gross margin percentages. They kind of topped out here at 83% this time last year and going into next quarter last year, compared to now where they've been steadily dropping to about 79% now. But I would say that is primarily due to, just increases in ad spend and just growing like crazy. So I'm okay with it as long as it doesn't continue to drop. I think it's I don't think it's a big deal, if I'm being honest. So this is how they broke down their GAAP operating expenses. General and administrative. Like I said, your primary is going to be your marketing. Which let's just talk about this real quick. So we had 51% of our GAAP operating expenses being used on marketing. Now, a lot of that is going to be your ads on Facebook, as we've all seen, and Instagram and TikTok, and everywhere where it's easy to just get in front of people and tell them that there's an avenue to get help without having to go into the doctor or so on and so forth. So seeing every single one of these pillars drop 16 to 11%, 6% to 5% on technology and development, 14% to 12% on operations and support, marketing 51 to 45% is absolutely massive. You have revenues going up, you have net income going up, you have earnings multiple going up, you have EPS going up, and then you have expenses going down. You have the balance sheet going up as well. It makes for a parabolic hockey stick move upward. Just phenomenal. And obviously the same thing here on the non-GAAP operating expenses. And as we can see, we flipped to profitability Q4 2023. And since then, we have just been a crazy parabolic move, especially to right now, a 32-cent non-GAAP EPS. It's just insane. This company is just flying. So we also, like I said, we have this nice free cash flow. We have this nice free cash flow growth right here. 79. So we went 311% higher than we were the prior year. And I expect us to, for Q4, probably be in the realm of around 20 million free cash flow, which, like I said, puts us at year end at about $159-ish million free cash flow. So that was really it for the presentation and the release they gave us. Now let's hop on over into the valuation analyzer. As we can see here on the valuation analyzer, we have a 4 out of 6 score on our valuation score. So with this valuation score, it takes into consideration your free cash flow yield, your 1 year or your forward free cash flow yield, so next year's free cash flow yield, your PE, your forward PE, your PEG ratio. I even put the rule of 40 in here, which they're exactly at a 40 ratio right now. And then it also breaks down through most of this, your discounted cash flow model, which gives us a intrinsic value or fair value of $40 per share on this company. And that's only with a terminal value or multiple free cash flow at the end of this 10-year analysis of 10. Now, this company is growing 30% plus, and then I expect them to continue to grow 20% plus, teetering out in 2030 to 2033 down to about high teens. And I only gave them a 10 multiple. and they are still at a fair value of 40. Let's just say I give them what I believe they deserve is a 20 to 25. So let's just say I give them a 20. That means their fair value is $65 per share. The stock today after hours, I think, got up to $22 and almost $23 per share. So just understand how absolutely epic of a deal you are getting on this company. At these prices, we are talking about a 54% annual CAGR. And we are talking about a 10-year CAGR of almost 35%, bringing the price 10 years later to $404 per share, bringing the price 5 years later to about $180 per share from today's price. We're talking about massive 10x opportunity here on this company. And honestly, I don't have enough shares. I need to be buying more shares. So everything else on here, I've updated from earnings. Like I said, I think they're going to have 160 billion in free cash flow here. And I have their revenue gross being 60% like they were for this year, and then being around 36 and then dropping down to 14% over the next 10 years. And their average, and I basically took these EPS numbers and these EPS growth rates from analysts, and they see them having $1.70 in 10 years time, which I honestly think is going to be a lot more EPS in that time, but I'm just going off by what analysts say. But let me know what you think about my valuation analyzer tool. Let me know what you think about earnings, and if you think the company had a tier 1 earnings like I do, and if they crushed it like I believe they do. And let me know in the comments if you're going to be buying more HIMs like I am. But besides that, guys, I really appreciate you joining me and making it this far in the video if you did. And like, subscribe, follow for more. And I'll see you in the next one. Have a great night.